Solo 401k tax planning strategies. Maximize savings. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. And on today's podcast, I'm going to talk about how you can maximize savings with a Solo 401k plan. But before we get started, I'm going to talk about what exactly is a Solo K, some of the advantages, and then talk about some of the maximizing saving options in the plan. So number one, what's a solo plan? Solo plan is a regular 401k that has no full-time employees other than the owners or their spouses. Full-time employees means over 1,000 hours during the year. So you're not going to find the term solo 401k anywhere in the tax code. It just means a plan that's not subject to the ERISA rules, which adds a lot of administrative headaches to employers. So most people want to go solo, easier to administer, and as you'll see in a moment, a lot more flexibility in terms of contributions. So if you're self-employed or have a small business with no full-time employees other than the owners or their spouses, you want to think about going solo. Trust me. So what are the maximum savings? What are the best tax strategies for maximizing your savings? Well, first is contributions. With a solo 401k, you can put away in 2022 a maximum of $61,000 if you're under 50, or $67,500 if you're over 50. Now it's broken down into two components. There's the employee deferral and the profit sharing. On the employee deferral, you can do $20,500 or $27,000 if you're over 50. And that's dollar for dollar, generally in pre-tax or Roth. If it's pre-tax, that means you get a tax deduction, which maximizes your savings and reduces your taxable liability. Now, the second component is the profit sharing, which allows you to contribute 20% or 25%, and it's a max of 20 if you're self-employed, sole proprietor, single member LLC, or 25% of your W-2 if you're a C or S Corp. So for example, you made 100K and you're under 50, single member LLC, 2022, you can do 20,500 plus 20K, about 40,500. So imagine that. You go from making 100, paying tax on 100, to now paying tax on negative. Well, if you do the math, it's 59,500, right? And all that money you're saving, instead of going to Uncle Sam, goes into your 401k where you can now invest it in stocks, mutual funds, but also if you pick a self-directed 401k, real estate, cryptos, private businesses, investment funds, and the like. So a lot of advantages. If you're over 50, you could do 27 plus the 20 or 47. And if you had a W-2 S Corp, C Corp, you can do plus the 25% instead of the 20. Up to a max of 61 or 67.5 if you're over 50. So the max contributions is the first tax strategy that will help you maximize your savings. Second is something called the Backdoor Roth or Mega Backdoor Roth, which allows you to dollar for dollar, 61 or 67,500 if you're over 50, straight into Roth. So that means if you made 66, 67,000, for example, and you wanted to go Roth crazy, which I would if I could. Why can't I? Because I don't have a self-employment business. Generally, most 401k plans of larger corporations will not be able to offer the Mega Backdoor Roth because it will fail the ERISA testing, better known as the ADP or ACP. So how it works is you essentially make a contribution of up to 61 or 67.5 if you're over 50 into your 401k and then into after tax, and you literally just move it to a Roth account. And you can leave it there and then invest it in the plan, or you can roll it over tax-free to a Roth IRA without a triggering event. So it's obviously super beneficial if you're a Roth lover. The third way a solo 401k lets you maximize your tax strategies is the loan feature. With most 401ks, as long as it's built into your plan document, you can borrow the lesser of $50,000 or 50% of your account value, and you can use that for any purpose, personal, business, as long as you pay back the loan over 5 years at a minimum interest rate of prime, which is 3.5% as of end of April 2022. It will go up as interest rates go up. And obviously you need to make the payments back quarterly. You can do it quicker, whether it's biweekly or weekly or monthly, but it cannot be longer than quarterly. And it's a straight line loan, 5 years. It's not a balloon payment. It's interest and principal combined. If you fail to pay it back timely, you can be subject to tax and a 10% penalty if you're under 59.5. But again, the loan gives you a great way to get tax-free penalty for use of the money, and also pay your plan back with the 3.5% or whatever interest you use. Fourth major tax strategy is real estate leverage. So if you are a real estate investor and want to take advantage of using other people's money to buy real estate, which every smart real estate investor, a friend of mine, says is what you need to do, and you want to do it in a 401k, or you are able to do it in a 401k, you will not be subject to what's known as the unrelated business income tax. Whereas if you use an IRA, you would be subject to UBIT, which can go as high as 37%. And the UBIT would be applied to a portion of the income associated with the debt financed income. So let's say you took 100K of 401k funds, or let's say IRA funds, and you borrowed 100,000 non-recourse. Why non-recourse? Because the Internal Revenue Code 4975 will not let you personally guarantee an obligation of your IRA. So that's why you can't personally guarantee the loan. So that means you do a non-recourse loan you don't personally guarantee, put 100K cash, borrow 100K, that's 200, buy a piece of property for 200. Let's say you have net income of 10,000 after depreciation and other expenses. 50% of that 10,000, which equals the debt finance portion equal to the equity portion, the 100 over 100, 50% would be subject to the UBIT. So 5,000, let's say in this example. Now, if your UBIT's under $1,000 because you got a lot of depreciation, you have other expenses, loan payments, and so forth, then you don't have to pay the UBIT and you don't have to file a 990T, which is the form that you will report the UBIT. So the ability to use the 401k and take advantage of leverage without UBIT tax is huge. Just make sure to remember it's got to be a non-recourse loan, and you got to use it to acquire real estate, not machinery, let's say, or equipment. So it's got to be real estate. But that's it. Those are the four major tax strategy that you can employ that will help you generate tax savings. Again, max contributions. The Solo K will let you go up to 61 or 67.5 if you're over 50, broken down into employee profit sharing. Obviously, employee deferrals can be pre-tax or Roth. Profit sharing could be pre-tax. So if you want to maximize tax benefits, you can do everything pre-tax and get deductions. Number two, if you're a Roth lover, you can do the mega backdoor Roth, go all the way to 61 or 67.5 dollar for dollar Roth. And obviously the maximized savings is so long as you're over 59.5 and the Roth's been open at least 5 years, then you never pay tax when you pull out the money from the Roth IRA. So it's not or. 59.5 and 5 years. Third loan, you can borrow 50,000 or 50% of your account value. Use that for any purpose, whatever you want. Tax-free, penalty-free use of the funds. And the interest you pay back to the loan is a return on the investment for the plan. And the fourth, if you're a real estate investor, the ability to take advantage of leverage without triggering UBIT is huge. Real estate investors love it. So something that you probably want to take a look at, and another obviously important reason to look at setting up a solo 401k versus the IRA, because of that option and all the other options I just mentioned. So thank you for listening. If you're watching on YouTube, thank you as well. Please, if you can, give us a good rating and subscribe if you haven't already. Otherwise, thank you for spending some time with me today and really appreciate it, your support. Really enjoy the podcast. So thanks for listening and see everyone again next week. Take care.